Hello everyone, welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 10 from the book How to Make Money in Stocks by William O'Neill. It has been created with the help of AI. The chapter is titled Why You Must Sell and Cut Every Loss Without Exception. You can read the original post at samfury.com.
Welcome back, everybody. Today, we're going to be focusing on something that can feel a bit counterintuitive for some folks, but is absolutely crucial for success in the stock market.
Right.
Cutting your losses. The reality is losses are inevitable. Even the most seasoned investors experience them. What sets the successful ones apart is their ability to manage those losses and come out ahead in the long run. That's what we're going to be unpacking today.
That's right. O'Neill is very clear that cutting losses quickly, and without exception, is the foundation of successful trading.
Okay.
And what's really fascinating is that he suggests you can actually be wrong more often than right and still make money.
Wow.
That might sound a bit shocking.
Yeah.
But it all comes down to risk management.
So if it's not about being right all the time, what is it about?
It's about making sure the times you are right outweigh the times you're wrong in terms of pure profit.
Okay.
So it's about making sure your wins are bigger than your losses.
Gotcha.
That's where the concept of the 3-to-1 profit-loss ratio comes in.
Okay, break this down for me. What exactly is the 3-to-1 profit-loss ratio?
Simply put, for every trade you make, you aim for a profit target 3 times greater than your maximum acceptable loss.
Okay.
So if you're willing to risk $1 per share on a stock, you would set your profit target at $3 per share.
So for example, if I buy a stock at $10 and I'm using this 3-to-1 ratio, my target price would be $13. And I'd set my stop loss at $9.
Now imagine you make 10 trades using this ratio.
Okay.
Even if you lose on 6 of them, your 4 winning trades, each gaining $3, would bring in $12.
Okay.
Outweighing the $6 loss from the losing trades.
Right.
That's a net profit of $6, even though you were wrong more often than you were right. It's pretty powerful stuff, right?
That is a great illustration.
Yeah.
It makes the concept much clearer.
Absolutely.
It really highlights how controlling your downside can lead to profits, even if you don't have a crystal ball.
Yeah, and the best part is this principle applies whether you're a day trader making multiple trades a day or a long-term investor holding stocks for years.
Right.
You can adjust the ratio based on your own risk tolerance and trading style. If you're aiming for a 25% profit, your stop loss would be set at 8% using this ratio.
So this 3-to-1 profit-loss ratio really gets at the heart of what O'Neill considers the secret to successful trading.
He's very straightforward about it.
Yeah.
It's not about being a stock-picking genius. It's about mastering the art of minimizing losses.
Right.
And the beauty of it is you can do quite well if you get just 1 out of every 5 picks right, as long as you're effectively managing your risk on the other 4.
But let's be honest, cutting your losses is often easier said than done. Emotionally, it can be tough to admit defeat and sell a stock that's losing money. We tend to get attached to our picks and convince ourselves that they'll bounce back.
Absolutely. We've all been there.
Yeah.
That's why O'Neill emphasizes the importance of emotional detachment. One tool he suggests is the would you still buy it test.
How does this help?
It forces you to look at the stock objectively as if you didn't already own it.
Okay.
Ask yourself, if I were looking at this stock today for the first time at its current price, would I buy it?
Right.
If the answer is no, that's a strong signal that it's time to let go, regardless of how much you might have lost already.
Yeah.
It helps you separate your emotions from the decision-making process.
That's a great tip. I remember holding on to a stock that was tanking and kept making excuses for why it would come back.
Yeah.
And then I asked myself that question.
Yeah.
The answer was a resounding no. That's when I knew I had to let it go.
Yep.
And you know what? It felt so much better to finally cut my losses and move on.
That's a perfect example of how this simple question can help you make more rational decisions.
So we've got this great tool to help us make the decision, but how do we actually put a concrete plan in place to cut those losses?
O'Neill has a very clear rule for that. The 8% maximum stop loss.
Okay, tell me about this 8% rule.
It's pretty straightforward.
Yeah.
You never let a stock drop more than 8% below your purchase price.
Okay.
If it hits that 8% mark, you sell no questions asked.
Wow.
It's like a safety net to prevent those small losses from turning into big portfolio-crushing ones. This rule is about discipline and removing emotion from the equation.
While the 8% rule sounds pretty simple in theory, I'm sure there are times when it feels very tempting to break.
Especially when you see a stock start to rebound after you've sold it. It's easy to think, oh, I sold too early, I should have held on.
Oh, for sure.
But O'Neill stresses that sticking to this rule no matter what is crucial.
And why is that?
Because you never know for sure if a stock will truly rebound or if it's just a temporary blip.
Okay.
The 8% rule protects you from the potential for further losses.
Okay.
Think of it like insurance. Just because your house didn't burn down this year doesn't mean you regret having insurance, right?
That's a great way to think about it. It's about protecting yourself from those what-if scenarios.
Exactly.
But is there ever a time when it's okay to deviate from the 8% rule?
Mm-hmm.
What if a stock is really volatile and you think it has the potential to make a big move?
While O'Neill is adamant about the 8% limit, some argue that it's too rigid. They suggest adjusting it based on market volatility or the specific characteristics of the stock.
Uh-huh. What are your thoughts on that?
That's a really good question and one we should definitely explore further.
Yep.
However, before we get into the nitty-gritty of stop-loss strategy, I want to make sure we're all on the same page about another key concept O'Neill emphasizes.
Okay.
Periodically shifting funds from weaker performing stocks to stronger ones.
Right, even if those weaker picks are currently showing a profit.
Exactly. It's about capitalizing on momentum and making sure your money is working as hard as it can for you.
Mm-hmm. Tell me more about O'Neill's strategy for doing this.
He recommends a simple monthly review process.
Okay.
Calculate the percentage change in the price of each stock in your portfolio from the previous month and rank them from highest performing to least performing.
Okay.
This gives you a clear picture of which stocks are leading the pack and which ones might be lagging behind.
So essentially you're taking a proactive approach to portfolio management.
Yes.
Weeding out the weaker performers and channeling more funds into the stocks that are showing the most promise.
Precisely. And this ties back into the concept of cutting your losses. It's not just about selling stocks that are in the red.
Yep.
It's also about recognizing when a stock, even a profitable one, might have run its course.
Right.
And reallocating those funds to opportunities with greater growth potential.
So it's about consistently evaluating your portfolio and making adjustments to stay ahead of the curve.
It's an ongoing process of fine-tuning your holdings to maximize your potential gains.
It sounds like this proactive approach could be a game changer for investors who are used to a more passive buy and hold strategy.
Oh, yeah.
But I imagine it also requires a certain level of discipline and a willingness to make tough decisions, even when it comes to selling stocks that are currently in the black.
You're absolutely right. This strategy challenges the conventional wisdom of holding on to winners no matter what. It forces you to constantly assess the market and make strategic moves to stay ahead of the game.
It sounds like a powerful approach. But I know that for some investors, the idea of selling a stock that's currently making money can feel counterintuitive.
Yeah.
Let's dig into that a little deeper and explore why O'Neill believes this is such a crucial part of successful investing.
Okay. Before we get there, it's important to distinguish between the 8% stop-loss rule and giving profitable stocks room to breathe.
Okay.
They might sound similar, but they serve different purposes.
Okay, I'm listening. What's the difference?
The 8% rule applies only to the downside to your purchase price.
Right.
It's there to protect you from big losses. Giving profits room to breathe, on the other hand, is about allowing your winning stocks to continue to grow.
So just because a stock has gone up 10% or 20%, I don't necessarily want to sell it right away.
Exactly. The 8% rule prevents you from losing more than 8% from where you bought the stock. But once the stock starts moving in the right direction, you want to give it space to potentially climb much higher.
So it's kind of like take your losses quickly and let your profits run.
That's a great way to put it. The key is to have a clear plan for both scenarios. The 8% stop-loss rule takes care of the downside, and your own research and analysis will guide you on when to sell a winning stock.
It seems like having this well-defined trading plan is crucial to navigating the emotional ups and downs of the market.
Absolutely. It's like having a roadmap to guide you through the inevitable twists and turns. It helps you stay focused on your goals and avoid making impulsive decisions based on fear or greed.
O'Neill emphasizes that the 8% stop-loss is just one piece of the puzzle.
Yeah.
He really encourages investors to develop their own personalized set of rules. What are some other elements that should be part of a comprehensive trading plan?
Well, you'll want to have clear entry and exit strategies, position sizing rules, and a system for tracking your trades and analyzing your performance. It's about creating a framework that works for you and your investment goals.
I imagine having a written plan also helps you to stay disciplined and avoid second-guessing yourself.
You got it. When the market gets volatile, it's easy to let emotions take over. But if you have a plan in place, you can refer back to it and stay the course even when things get tough.
Now, I know some people might be thinking, well, I'm diversified, so I don't really need to worry about stop losses. What would you say to that?
Right. Diversification is certainly important, but it's not a foolproof strategy. In a bear market, which is a period of prolonged decline in the stock market, even well-diversified portfolios can take a hit.
And what about the argument that good stocks always recover, so why bother selling them if they drop a bit?
While it's true that some companies have a track record of bouncing back from setbacks, there are no guarantees in the stock market. Even blue-chip companies, which are typically well-established and financially sound, can face challenges that lead to prolonged periods of decline. And sometimes what seems like a temporary dip can actually be the beginning of a much larger downward trend.
So even if you're confident in a company's long-term prospects, it's still important to have a plan in place to limit your potential losses.
Exactly. A well-defined stop-loss rule protects you from both market risk and, perhaps more importantly, your own ego and wishful thinking. It's about taking a realistic view of the market and acknowledging that no stock is immune to downturns.
O'Neill is really driving home the importance of loss management.
That's really what sets his philosophy apart. It's not about trying to be right all the time, but about managing the inevitable times when you're wrong. It's about acknowledging that losses are part of the game and having a system in place to deal with them effectively.
I love that perspective. It takes the pressure off of trying to predict the market perfectly and instead focuses on what you can control your own actions and reactions.
And by shifting your mindset in this way, you're more likely to make rational decisions and avoid getting caught up in the emotional roller coaster of the market.
It sounds like this mental shift could be just as important as any technical trading strategy.
Absolutely. It's about developing the discipline and emotional resilience to stick to your plan, even when it's tempting to deviate.
So to sum up, what are the key takeaways listeners should remember from our deep dive into O'Neill's philosophy on cutting losses?
First and foremost, accept that losses are a natural part of investing. Don't let them discourage you or make you doubt your abilities.
And instead of trying to avoid losses altogether, focus on managing them effectively.
Right. And that's where the 3-to-1 profit-loss ratio comes in. Remember, even if you're wrong more often than you're right, you can still come out ahead if your wins are bigger than your losses.
Having a well-defined trading plan, including a strict stop-loss rule, is also essential.
And don't forget about the would you still buy it test. It's a powerful tool for making objective decisions and avoiding emotional attachment to your stocks.
Finally, remember that diversification is important, but it's not a substitute for a sound risk management strategy.
Right. Even in a diversified portfolio, controlling your losses on individual stocks is crucial to protecting your overall capital and maximizing your returns.
All right, I think we've covered a lot of ground today. Before we wrap up, I want to leave you with a final thought-provoking question to ponder. If you could choose just one rule to guarantee your success in the stock market, what would it be?
That is a great question to reflect on. It really highlights the importance of identifying your core trading principles and building your strategy around them.
There's no one-size-fits-all answer, but taking the time to really think about what matters most to you as an investor can be incredibly valuable.
Absolutely. It's about defining your own personal philosophy of investing and creating a set of rules that align with your goals and risk tolerance.
And it's not a one-time exercise either, is it?
No.
As you gain experience and learn more about the market, your approach might evolve.
You hit the nail on the head. The journey to becoming a successful investor is ongoing. It's about constantly learning, adapting, and refining your approach as you navigate the ever-changing landscape of the market.
Until next time, happy investing, everyone.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.